Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. I'm doing a video on a Sunday today, so a little bit off script. And today's not even a news video, it's more of an opinion editorial type video. So hopefully you'll enjoy it and it'll give you some food for thought on the housing industry. So wanted to actually have a little talk today because I actually had a chance to have a discussion with I'll call it, for lack of better words, a Wall Street CEO. And what I mean by that is an actual CEO of a Wall Street firm that's involved in the financial side, bonds and mortgage-backed securities and stuff like that. So the history of how I went about this is I actually have a colleague who I've known for about 20 years. Haven't kept in touch with him, too often over the past number of years. But he actually is the CEO of, he a couple of years ago was named CEO of a firm who's involved in, financial backing bonds and issuing, insurance on mortgage-backed securities and stuff like that. So he certainly is aware of the housing market and what's going on. And I thought I'd give him a shout just to get his take on what's going on in the housing industry, seeing what he believes is happening now and where he sees the market going in the very near future. It's always good to get different perspectives from people that are in the industry at different positions, and I thought I'd have a discussion with him. So after a number of weeks of trying to fit into his schedule, because he's a busy guy for sure, we actually had a talk a couple of weeks ago. And to be upfront, my intention was not to actually even talk about it on the channel today, but the more I thought about it, it's a good piece just to to discuss, and also gives a perspective of somebody else who's involved in real estate, albeit from a different perspective. He's certainly not feet in the street like sort of we are at this point in time. He's in a different realm, obviously, and he's looking at things from a different perspective. But he's based in New York, obviously the New York area, so a lot of his perspective will be what's happening in that location, which I think is interesting as well too. So anyway, I've known him for about 20 years, and good caught up, and I just want to make sure that people realize this is not a formal interview. I'm not going to mention his name or his corporation, because that's not what we agreed to. We agreed to just having a conversation, and I figured I'd relay what he sort of discussed with me and his opinions, etc. So I asked him a bunch of questions, and he really gave me his thoughts as to where he sees the real estate market going in the near future. So just as an FYI, just remember, guys, if you're not already a subscriber, please click the button to the bottom right of the video here and subscribe to help my channel grow. I appreciate it very much. Thank you. Again, he's sharing a perspective on the marketplace, and the market's different from different perspectives, from where you are and what you do in it, and where you're located across the country, obviously. So this is some kind of a summary of what he has had to say about it. So the real estate market is very sensitive to rates, clearly. Rates are so low that it's almost free money. It's kind of like quantitative easing all over again, which is what he said. He sees some continued growth, but the growth will be regional in nature, which is sort of par for the course. We see certain locations growing faster or decelerating at a slower pace than other locations across the country. But this is very interesting. He sort of said that buyers nowadays do not want to purchase massive homes anymore. And the reason being, they're just too big, they're too costly, needs to be maintained. There could be deferred maintenance or future deferred maintenance you have to engage in. So really it's not what today's buyers are looking for in the real estate market, which I do have to agree. People are moving closer to the cities nowadays, and there is a trend in urban living. That's where he sees a lot of the next generation, a lot of the next buying wave occurring. It's urban living. Millennials are more interested in, I guess you could say, gentrification. And what he means by that is the fact that they're going towards older, more rundown, cheaper neighborhoods. And if you want to know why, well, it's because that's all they can afford. So it's kind of like you're not affording, you can't afford or don't want to pay those high prices. So therefore, you're going to do things differently and try to figure it out. So and the thought is, when millennials or other generations move into the areas that are going through gentrification, those neighborhoods will slowly change, and they'll become more cooler, more hip, more interesting locations as time goes on. But it does take time. When some people move there, they maybe rehab a house or make it a little nicer. It attracts other people, their friends, other family members may join them in the area, and as that grows, it adds and attracts restaurants, other small businesses, art galleries, coffee shops, little fitness gym locations, yoga studios, things like that. Other interesting meetup places, etc. So it's really, he sees a lot of it shifting, housing shifting towards the urban life. People that can walk, bike, or take transit to their jobs is more favorable than that long commute. And they do things, or they want to do things, and have experiences with what their local area has to offer. And their next generation is more concerned about things like their pets and lifestyle, as opposed to owning that big McMansion, which I think a lot of us are in agreement with that. We've seen the trend is not buying those huge homes. It's actually being more compact. There's more shared living. There's less less material, less a collection of things or ownership of things. It's more, let's have lifestyle and enjoy the location, the surroundings, what the local city has to offer. So, and again, I see this going on a number of locations in my region and parts of town where I live. I've been been here for quite some time now, so I know there's certain locations in the greater Tampa area that I can see over the past couple of years are really going through gentrification. And you see the restaurants coming up, you see food trucks hanging out, you see brew pubs, I guess you could say, putting developments there, the repurposing of a lot of maybe warehouse type locations or rundown buildings to more hipper, interesting things that are going on, a lot of cafes and stuff. So, neighborhood eateries, different stores popping up. So you start to see this, and as that, as those communities grow, more infrastructure comes into play, more people move there, they take better care of their properties, they make improvements, and neighborhoods just kind of flourish. So I see that happening quite a bit. He certainly mentioned that SALT, state and local taxes, is hurting his area, and his area is New York, New Jersey, Connecticut area. Tax changes, the lack of deductions are hurting the market big time. He certainly says there's less foreign investment that's going on in that region up there, which is very obvious, and the loss of the Chinese money is specifically hurting. He feels the New York area for sure. Comments across the board. No place or metro area is great these days, but people will go to where the jobs are. They are willing to relocate, and again, it's shifting more towards quality of life. Can't keep up anymore, can't pay the high prices, don't want to commute 2 hours each way, so that people will move towards jobs if they can relocate. The general feeling is that the U.S. economy is good, but doesn't mean that there won't be economic market corrections in the near future if they're required. He feels that there's a crunch on day-to-day debt going on right now. Specifically, there's a lot of refis happening in the marketplace, and we've noted that over the past couple of months when we've had the lower rates. What we've seen is a shift from purchase applications to more refinance applications going on. So rates, it's more rate sensitive, and people aren't necessarily, so the lower rates haven't stimulated purchases, it's stimulated refis, and a lot of these are cash out refis. He mentioned people are taking equity out of their homes, and a lot of reverse mortgages. He sees a lot of reverse mortgages being advertised, and actually people jumping into them. The older generation jump into the reverse mortgages. They're becoming very popular. This is a growing trend. When people are pulling equity out of their homes, this is something that needs to always be watched and monitored, because if we go back in time, and I mentioned this quite often about the lost housing crisis, one of the big culprits of the housing crisis and the crash and the bust was not necessarily the subprime mortgages, but really the cash out refis that were going on. So, and we've noted that cash out refis have been increasing every quarter for the past number of years, and will continue to increase, obviously, when rates are low. So also, he felt that the real estate market as a whole has been flat since 2017, and I have to agree with him on this too. So we've seen prices cool off, and in different regions, we've seen the deceleration of appreciation going on. High-end real estate is getting crushed, and especially in the bigger cities. So we know that, like the New York area, the San Francisco area, the Miami area, where we have the large developments and these higher priced condos and apartments and homes are really just taking a beating now. He said buyers from China, Canada, Brazil, South America, there's less and less of them from obvious reasons. They're also very dollar sensitive. So when the U.S. dollar is stronger in the economy, less foreign money is coming in to buy, because it's not that great a deal anymore. So a lot of the foreign investment certainly pegs around the dollar. strength of currency issues. Also political sensitivity as well. There are certain cultures who do not want to, I guess you could say, invest and or relocate to the U.S. right now based on some of the political climate. So again, we see this with price points and reductions on the high-end market. Also growth in inventory. So I know that places in Miami, for example, that you've got a lot more condo developments and a lot more inventory coming online. We've seen that the new taxes have sort of really hurt. I'll say have hurt the marketplace in the New York, New Jersey, Connecticut area. A lot of people are relocating out of those locations. Places like Illinois, people are relocating out of Illinois or out of Chicago, and even obviously the West Coast. Just can't afford it. Why keep paying these high prices? And then if you have less mortgage deduction opportunity and taxes going up, your money's not going as far. See if you can relocate and go someplace better, get a better quality of life, more bang for your buck with your home purchase. So. And again, we'll see, and we're seeing now, especially in New York City, the $2 million and above, like the luxury tax is hitting people, and also that's going to affect developers and home builders, etc. So it's sort of going to permeate through the marketplace. He does not see interest rates or mortgage rates going up, which is fairly consistent with what we've seen with the Fed, etc. He said corporate loans and car loans are getting crushed in the market nowadays, and he doesn't feel that we're in a national housing bubble, but regional metros could have issues, and that's because of some of the shifting and relocation going on with people across the country. One thing to note, though, and this again is not a knock on him whatsoever because he's a very smart man, it's more of a awareness situation because, again, when you're a CEO of a firm that does a certain thing, you're probably not aware of all the local issues that are happening in various locations across the country. So he wasn't really aware of the increase in foreclosures around the country. He was more focused on his awareness just because of proximity around the New York City area, which would make sense because he operates there. However, he did agree that, with respect to mortgages these days, that people are pushing the risk with mortgage trends, having the lower the higher DTI availability, a lot of low down payments. It really is. People are risking more in their mortgage and purchasing, etc. And a small shift could cause them some pain. He did mention that he felt Florida is a great state to invest and grow, just because our state and he goes a lot of locations in the South as well are recipients of relocation of people leaving the cold, leaving the high tax states, the mortgage deductions, whatever. They want to go someplace where lifestyle, better climate, whether and again, certain states have lower state tax or even income tax or even lack thereof. Just people are looking for a change and they want their money to go farther now. So he did say Florida is a great state to invest and grow, which that's what I say as well too. So there you go. And he said that Florida will be the benefactor of a lot of the SALT and tax deduction changes from the Northeast, which is great. So summary, it doesn't feel we're going to have the same type of crash or issues we had back in 2007, 2008. I don't think anybody thinks that, and I don't think that as well too. However, I do believe that we're going to see some sort of shift that we can't quite figure out yet. And he does agree that something has to give, because people just aren't able to keep up with these prices and or what's affecting their bottom line with the state and local taxes and mortgage deductions or whatever. So people will look to put their housing money where it suits them better, and that could have a sort of, I guess you could say, a drop down effect in various locations across the country. So that's kind of the discussion point. I mean, it was good to hear from him and just get his take on things. That's sort of my perspective. I always like to listen to see what people have to say. So there are always would be the people who believe we're having, we've got housing issues. How far and how deep this goes, it really is the roll of the dice right now. I still, one of the things we sort of talked about and even mentioned here was this respect to the iBuyers. So basically, there's more and more iBuyers out in the marketplace now. They are expanding into more and more cities across the nation. I personally think that's going to be the wild card that we didn't have in the last housing crisis. And the iBuyers are going to be there to pick up a lot of property in advance of the other hedge funds, etc., which will still make it difficult for retail buyers to get their hands on more inexpensive properties. So that's kind of the scoop that we have to, like I say, look out for and see if we can work around and find solutions. It's more convenient for sellers, of course, but definitely not on the buy side. So it's a difficult time for home ownership right now. So that's a scoop for that. So I just want to give you a little heads up, a little op-ed here on someone else's opinion besides my own regarding housing. My opinion is still the fact that things like iBuyers, things like social media, we didn't have in the last housing crisis. So that's going to push the market in places that we haven't really seen it go, which will be interesting. We do have issues with respect to affordability still. One thing that did come out, and I haven't had a chance to do a video on it, but if we take a look at prices, so if we see that resale home prices are still, again, what I could say, deceleration of appreciation is going on. We've seen less home sales the past month, and we'll probably see that trend continue. But what happened recently as well is the new home sales. So new home sale reports were less home sales, but the big thing was the median home sale price. So we've been seeing the slide in the median price of a new home, and this past month of September, that median price dropped down below $300,000. The median price for houses across the board, new homes, were $299,000 and change, which has been, I think, an 8 and almost a 9% drop from the previous month. So what we are seeing here is that builders are trying to sell off inventory or trying to make deals, so they're reducing prices. And besides reducing price, they're offering incentives on upgrades, on certain premiums. They're willing to build in closing costs incentives as well too, and seller concessions if you're using their mortgage companies, things like that. So you're trying to bundle it all. But we do see so if you think about it, if you look at home price trends, certainly the new home sales price trends have been seen month over month decreases now that are fairly substantial. Remember, a few months ago, 6 months ago, the average home was $330,000 and change. Now we're at $299,000. So that's a good 10-12% we've lost over the past couple of months. So that's where we're starting to see some change right now in price points, and the rest of the country is slowing down with respect to the trend in appreciation. So there you go. So thanks once again, everybody. Do appreciate those who attended my fall foreclosure seminar event the other day. It was great to actually meet people who we communicate with on the comment section here. So I do appreciate those that came out. It was I really enjoyed it. Great to connect with people. There's quite a few people in the area, which I didn't realize, so that's good to know. And again, I have a little real estate club, and I'll do events every so often. So please, I encourage you to connect with me and come out as well whenever you have a chance. For those of you who are looking for more information and real estate training, just drop me a line. Obviously, my information has been cycling there on the monitor. You can hit me up with an email. If you're going to email, certainly leave your phone number where I can get in touch with you. And yes, I do have training courses on real estate, from your basic retail to basic retail and basic investing into advanced short sale investing right now, because again, that's where the market is, that's where the inventory is. It's not being touched right now. So anyway, appreciate time and the views and the comments. Please like and share the video, and we look forward to speaking with you later on this week.